Hello and welcome to another episode of Startup Caps, where this week we're diving into early stage investing. Those investors that give startup founders their first vote of confidence with risk capital. Now, we know that on the African continent, there's approximately 618 active hubs, with South Africa and Nigeria leading with 85 and 80 hubs, respectively. Now, these hubs are crucial for startup ecosystem development. They offer mentoring, support, infrastructure, as well as access to market and networking opportunities that gives those startup founders that first push. Let's take a look at just what exactly early stage investing is.
Startups typically go through several stages as they grow and develop, each attracting different types of capital. The pre-seed stage is all about laying the foundation with ideation, testing, and market analysis. This stage involves initial funding from friends and family, grants, incubators, and crowdfunding. Seed stage is when a startup confirms market demand and validates the business model. Startups attract seed funding from angel investors, venture capitalists, and crowdfunding. Series A is about developing the first product and gaining initial customers. Funding is usually from venture capital firms. Series B is about scaling operations and entering new markets. This stage attracts larger venture capital investments. Series C+ is about expanding product lines and market reach. Funding sources include late-stage venture capital. IPO is about achieving liquidity through public offerings. In simple terms, everybody can buy shares in this company now. This stage involves funding from IPO investors, bank fund, and of course, the public. Let's dive deeper into the pre-seed stage and seed stages. These early stages are crucial for laying the groundwork for a startup's success. Pre-seed stage is all about laying the foundation with ideation, testing, and analysis. Initial funding often comes from friends and family, grants, incubators, and crowdfunding. Activities include validating hypotheses, understanding market needs, and presenting a business plan to potential investors. Seed stage is all about confirmation of market demand and validation of the business model. Attracts funding from angel investors, venture capitalists, and crowdfunding. Activities include developing a minimal viable product and making key market connections. Now let's focus on pre-seed and seed investing in Africa. Despite global economic challenges, Africa's startup ecosystem shows resilience and growth potential. In 2023, volume of deals in Africa was at 545 venture capital deals, with the seed stage remaining the most active segment, accounting for 37% of venture deals. Although the number of deals decreased by almost half to 199 from 355 in 2022.
And now that we know a little bit more about early stage investing, let's take a look at a conversation that I had with early stage investors. I spoke to Nick Allen, founder and partner at Xamont, as well as Maelys Carraro, partner at the Catalyst Fund. Let's take a look. What is the significance of splitting the investment stages? Because we don't necessarily see that in other capital markets. We have early stage, Series A, Series B. Why are we splitting it this way?
So there's a journey that a startup goes through, right? From the very beginning of founding a new company to when you get to a point where you're listed in the public markets, for example, right? And at each of these stages of growth, you need different kinds of capital. So at the beginning, you may need less capital, but you need enough to get your product going and testing and get to product market fit. And it's a certain kind of capital that has risk appetite, right? So that's what we call the pre-seed seed stage. And then once you have proven your model and you're really trying to get traction and grow in the market, that's when you need growth capital. So you need more, and from a different kind of investor that understands that stage. And that would be your Series A, Series B, growth capital. So in essence, the stages of capital match the stage of development of the business, and it's quite intentionally built that way to make sure that companies are successful.
Could we call this risk capital? High risk capital even?
Absolutely, yes.
So then if we go on the premise that this is high risk capital, what do you look for in making the decision to actually go forward with an investment?
I think it does depend, again, on that stage that you're investing in, because at the very early stages, you've really got no track record. So if you're investing pre-seed and seed, you don't really have a lot to go with. So at that stage, you're looking at the basis of the idea of the innovation that you're working with, the caliber of the team. So at those stages, you're trying to work out, is the nub of this opportunity real? Do we have something that we can work with, that we can invest in? At those stages, it's often quite a real bet. You are hoping that these things can come to fruition. As you get later on, then you have more tangible outcomes to guide you and indicate whether you're going to have a successful startup. And I think that then determines A, the amount of capital that you are putting in, and B, the kinds of valuations that you are setting for those businesses at those stages.
And that's something I want to come back to, valuations. But before we get there, I have a question for the both of you. We're talking high risk. We're talking, you use the term bet. for a big part, it is a bet. How much do you expect to lose in any, let's say if you go through 100 deals, how many of these deals, within how many of these deals do you expect to lose and not make any kind of return?
Well, again, it really depends at the stage you invest in. I think both of us invest quite early. We invest extremely early. We're typically the first investor in a company because we're at the pre-seed stage. So of course, the numbers of those that will not go anywhere or fail are higher. So you need to build that into your model. So we are assuming that maybe 30-40% of the businesses will not actually succeed in our model. So we plan, for example, to invest in 40 businesses at pre-seed, follow on in 50% of those at seed stage, and then only 25% of those, so 10 at Series A, right? So in essence, 25% of those will make it through those 3 stages, and that's our prediction, right? So of course, failure rates are high, but that's also the name of the game. You have to try different things, you have to innovate, you have to place different bets and see which ones are going to be the unicorns.
And Nick, for you?
Very much the same. I mean, if you're investing at pre-seed, so out of our first fund, half the investments we made were pre-seed, and again, we expect half of those, won't make it onto the next stage. And again, you build it into your models. You write relatively small checks at that stage, give the guys the opportunity to demonstrate what they can do. And then those that are making it through, you then write a bigger check to get them onto the next stage. But it is, there's at this early stage, so much can go wrong. So you have to be aware and open to taking those chances.
Because at this stage, I mean, sometimes, and I can imagine quite a lot, you're dealing with startups that don't even have a product yet. It's an idea, a presentation, a pitch. So how do you go about valuations in this case?
Well, not quite. We do invest a little bit after the idea and tech. That's usually for incubators and studios. So typically the stage we invest in, there's a product in market, there's some revenue. We have invested pre-revenue in some cases where we saw exponential potential for growth. Typically there's some data that we can work with to really support the founders in taking those next steps, right? In terms of valuations, we look at the market. So, we study what the trends are. So typically for a pre-seed, seed deal, you'd see valuations between 2.5, 3, and say 6. And even that's probably on the expensive side, I would say. So it depends on the market and the sector. And then the typical valuations you'd see, obviously, at seed are also informed by the market, right? So we try to understand the potential of the business, the sector that it's playing in, the competition, the strengths of the founders, and then align with other investors around the numbers.
Now, you're both in completely different regions. You're based in East Africa, Nairobi, Cape Town, Southern Africa. And when we're looking at the startup ecosystem and the landscape, we're seeing a lot of startups, which is very good, solve local problems. So how do you address the concern with regards to scalability when you're faced with these highly localized startups?
The kind of opportunities that we're looking for are based on technologies that are relevant locally, but also have opportunities elsewhere. So, that's one thing that we're always looking for in the opportunities that we invest in. They've got to have the ability to scale beyond the local markets. And whether that's, further up into the continent or into Europe, the US and South America or other areas, that's a key component of what we're looking for. We're a hardware and deep tech investor, so we're looking for those innovations that have built significant science and engineering, intellectual property, and they can then take those relevant solutions into other markets. So that's a key thing. So it's not just selling in the Cape Town market. It's great to make your mistakes, you make your learnings, prove your product locally, but then being able to scale it into the international market.
And the other part to that as well is, of course, the market fragmentation, if you can put it this way, and the different legislations, the different regulators that startups on the continent have in terms of being able to reach critical mass and being able to scale. How do you look at, let's say, regulation uncertainty when investing in early stage startups?
Great question. That is a tough one because you're right. The continent is quite fragmented. Regulation can shift and change. So you have to be aware of those changes happening and support the founders in navigating those changes, which sometimes can come kind of out of left field, right? The way we advise our founders, though, is to build relationships with regulators and governments quite early. So not trying to build and hide, but rather, if you know you're going to need those regulatory approvals, be open the dialogue. And especially if you want to go to another market, learn from others that are local, how they've done it, what they've done, maybe form partnerships, which would make it a lot easier to enter a new market, or think about acquisitions to enter that market so the licenses are already there. And those are all strategies that I've seen being very helpful to navigate regulatory challenges while you scale.
And you use the word markets, going into new markets, because there's the continent, but there's also outside of the continent. And we've seen quite a few startups go into Southeast Asia, going into the Middle East, going into Europe, going into the US. What about startup migration? I don't know if this is a term or if I just made it up, but the fact that we are seeing startups that start in Africa, solving African problems, and then continue to migrate and actually move the entirety of their operations and then even list on other stock exchanges. Yeah. How do you look at that?
That is, something that we really want to encourage, particularly if we're going to get our companies to scale beyond our local markets. Often the kinds of capital that they require aren't necessarily available here. There's certainly, as a conversation we've been having, in the community, there's not necessarily those Series B, Series C bigger tickets available on the continent at the moment. So if you're going to scale, that capital is really available in more developed markets. So you need to be in those markets in order to attract that capital. So we certainly work with our companies to set them up at some degree, in international markets, have a presence there so that they are able to attract those bigger tickets to start with, but also address and sell into those markets more effectively. Often we'll see the core of the operation still here in Africa, but the registration of the company and the presence we do a lot of establishment in Europe. The US is obviously an attractive place to set up, particularly if you're going to attract US money. So it's something we certainly work on.
Now in closing, early stage, which means that you have your eye on the hottest thing to come. So I want to get your perspective, your top 2 bullish markets. What sectors are you most excited about? Starting with you, Mylis.
We are an early stage climate tech investor. So I will say hands down, the climate tech innovations that are emerging across the continent are extremely exciting. And we see that in particular in spaces like decarbonization and agriculture, which is of course a massive sector from a GDP perspective and employment, and with a lot of potential for scalability and impact.
What a fascinating conversation. Now that we know a little bit more about what it takes to be an early stage investor, let's speak to another founder that actually became an investor himself, using his platform to actively support fintechs and allow them to build their infrastructure and grow on the continent, as well as making a few strategic acquisitions himself. I spoke to Dare Okujo, founder and CEO at OnAfrique.
What does making borders matter less mean to you?
Thanks, Daria. I think really the best example is what has happened in the telecommunication industry, where we are now literally living in a borderless world when it comes to making phone calls. So you pick up your phone without thinking about it here in Johannesburg, and you just dial a number, and it can ring in Madagascar or in Senegal or in Egypt. You don't even think about it. We want to replicate that experience for money, so money to move, and not only within Africa, but between Africa and the world, and from the world to Africa. And you're absolutely right, we can't do that alone. And the starting point is to understand that our approach is to build a network of networks, which assumes first that there is initial networks. And those networks initially for us were mobile money networks, largely driven by mobile networks, MTNs, Orange, Airtel, Vodafone, and the like. So they have been historically our first partners, and we learn with them how to craft the partnerships that not only work for us, work for the partners, but work also for the end users. The other thing is we are infrastructure provider at the end. So what we do is to provide payment pipes or payment rails, if you want, across the continent. But this will mean nothing if nobody uses them. And people who use them are come in different shape or forms. First, the mobile networks themselves. So a very well-known service now is cross-border mobile-to-mobile payments, where you can pick up your phone here in South Africa using the MTN Momo service, and you can send money to Airtel in Zambia or to Orange in DRC. And we repeat this across 40 countries on the continent. But there are other use services, which is other form of partnership. This is with other fintechs, where there is Loan Clouds in Tanzania, Numida in Uganda, 4G Capital in Kenya, M-Kopa, Cheaper Cash, number of fintechs or tech company, tech startup across the continent will use or are using our infrastructure today to make money move, whether it's to disperse or collect a loan, whether it's in the process or in the context of e-ride services. Safe Border in Uganda is a good example. We use our services to pay the driver, but also to collect money from the user. So all in all, our business really relies on those partnerships. First partnership to create this network of networks, and other partnership to make this work for businesses that are either using it for themselves or resell it to their customers.
How has regional integration been able to assist you? And I'm thinking about the East African community, the AFCFTA. How is this playing in this area?
Yeah, it's complex. I mean, to keep it short, but it works, or the way we approach it is on the technical side or framework. We think about the network that we're building in 3 layers. A layer, what we call the messaging layer. That is the technical part. That's a bunch of APIs, and that's already borderless. APIs will work. Code. It's basically line of codes. Then there is a compliance layer. And that is indeed, where we have to make sure that in every single country, in every single services, we are fully compliant with local regulation and global regulation. And this is a bit of art to keep stitching these things together. But the key principles of cross-border payments are well understood. It's around anti-money laundering, combating terrorism, customer protection, and understanding the inherent risk of your services. And we have very, very good teams who spend a lot of time understanding this, but also engaging with regulators through our partners or directly to make sure that we comply to that. And then you have the settlement layer, which is the third one, which is really how the money moves. Now, what I did not say, because I tend to take it for granted as well, but it's not that obvious, is all our payments are real time. And when you pick up your phone in Uganda and you make a payment to Zambia, mobile to mobile, it is real time. Now, that's not how banking system works today. If you move money domestically, maybe in some countries like South Africa, Nigeria, you can approach real time, but cross-border certainly not. This is something that is very important to the customers. Mobile money has created the expectation that money moves instantly. And people don't really make the difference between whether this is going cross-border or not, the same way they don't if they make a call. So it's not like when you call international, now you have to wait for the person to pick up. So that means we also have to, building a settlement network across all these countries is actually much more difficult than the first order layers, the compliance layer and the messaging layer. Now, you mentioned regional integration. What we're seeing is the payments follow trade routes. And really, it just, you look at where the centers of trade routes, Cote d'Ivoire is clearly one in Francophone West Africa, and even with places like Ghana and Nigeria. Kenya is clearly one in East Africa, South Africa is another one. And within those, you can find pocket of trade route like Zambia and DRC around the Copper Belt. And you will find from Mombasa all the way to Goma and all the way to Dar es Salaam port for Malawi. So, and that's where we need the regional integration, because if people cannot trade with each other easily, well, payment won't flow easily. And that the more we see integration, as I mentioned, the ECOWAS region or the UEMOA zone, where integration is very strong, you see much stronger cross-border payment. Where it's a little bit weaker or is non-existent, it is also, we can see that in our transactions.
Now, we've just been speaking to early stage investors and how their role is very much to bring in the risk capital so that innovation can take place, so that young, fresh ideas can have the capital required to be able to test the market, test the product, and grow. How do you view this? And particularly in terms of being able to reduce the cost of remittances, reduce the cost of transacting. Is this crucial?
It is essential, and you use a word there, Tanya, fragile ideas. I think that's actually the role of startups in any ecosystem, in any economy. Fragile idea requires frail hands, and I think that's for me is what startups bring to the ecosystem. It may not be apparent initially, but the very idea that we could erase borders for when it comes to payment, when we started, that was a fragile idea, in 2010. And now we can sit on this stage and talk about it, not just as a dream, but because we have proof point around that. And I think that's very important. The same thing when we started, we said, well, one of our goals will be to reduce cross-border payment cost within Africa to a single digit. At that time, it was somewhere between 17% and 20% when you move money between two African countries. And here in South Africa to Malawi, it was close to 30%. Happy to report that within our network, what we see, we are somewhere about 7 and 8% today. Now, it's not done yet, and until it's single digit everywhere. And one of the key theses that we hold, one assumption we're making is that if we are successful, even when these payments are not flowing for our wells, if you believe economics, right, in a perfectly competitive market, price should be close to marginal cost. And if we manage to really drive the marginal cost into these single digit territories, then even if it's not flowing through our network, we will see cross-border payment across Africa, in a single digit territory.
What about the corporates? Because you have a number of partnerships with very big players on the continent. And some have argued that corporates play a crucial role because they have the existing critical mass in terms of consumers and users. The infrastructure exists. How do you view this?
Yeah, so as much as, startups are there for fragile ideas, I think corporates are perfect places to scale, they offer distribution most of the time. So once the idea gets to a point where it can indeed, it is taking shape and is being proven in a smaller scale, corporates are fantastic enablers. And we have seen it ourselves. It is through our partnerships with a lot of the mobile networks across the continent that we have now created a reach of 500 million mobile wallets across the continent. Sure. Now, that reach is not just the reach for us. I mean, we don't actually sell any product, really. We just create the platform. But that reach is what now makes a group of kids in Lusaka or in Bangui or in Antananarivo, they now have access to a market of 500 million people. Because if they build a service that can plug onto our network, that service can now become available to all these people. And we couldn't have done that by ourselves. We have done that because we've been able to pull together partnership with very large corporates who have those reach and now make that available to startups across the continent.
Now, reflecting back 14 years, there's been a lot of entrants in the fintech space, in the payment space on the African continent. Is there still room for new entrants?
Oh yeah, it's still day one. I think again, think about it. It's when it comes, payment is so essential for any economy, and good payment, digital payment, it is a crucial enabler. I will argue is as important, if not more important, than roads, bridges, railroads. And we still have not been able to smooth this out everywhere. And I'll give you a few examples. Once you get payment right in general, or payment gets really subtle when you start going into verticals. What you need in the transportation industry or in the travel industry is actually quite different what you need in the agro sector. And it's quite different from what you'll need maybe for education. The other day I learned now that there is a whole payment industry around rent, how you could actually optimize for landlord and the tenant around that. So there's so much space where you can keep optimizing that, I think we're just starting. And it will get even more exciting once we get beyond what I still call the basics. The basics is I pick up my phone anywhere in Africa and I can make a payment to anyone else in Africa or in the world. Once we get that right, we will see even more exciting use cases coming up.
And this is how we wrap up Startup Caps for this week, but the conversation doesn't end here. You'll find us on social media with the handle _Startup Caps on X, Instagram, LinkedIn, Facebook, as well as TikTok. And of course, you can find out more information about the guests featured on this week's episode on the website www.startupcaps.io. That's it for this week. We'll see you again next week.